When you play into the $1 million room, it's different strategies that you have to put in place. But I hear a lot of real estate is a magic tax shield.
We do make lots of taxes when you sell real estate wrong from the tax perspective. What that allowed me to do was recognize the first $100,000 worth of capital gains at 0% each year. It was a six-figure tax lien for me each year. That $500 dishwasher didn't double in value to $1,000. What's a used dishwasher worth? $50, $100?
That's why when I heard you, these recapture is triggering me. Hello, I am so excited to introduce you today to one of our guests, and his name is Keith Blackborg. He's a CPA, a wealth advisor for high net worth investor, and also a tax strategist advisor, and also a dynamic podcast voice. He works with family office, self-directed IRA, and help them structure, protect, scale their asset across generation. Welcome, Keith. Welcome, Keith, and thank you for driving all the way from Dallas to Austin for this interview. And I've been very intriguing about what you do, and you'll be able to help people, help investors along the way. So I'm just intrigued about it. And all the information that you share with me is also new to me as well. So I'd love to share with the audience about it. So Keith, tell us a little bit about yourself, what you do, and your background, and love to hear more.
Thanks for having me. Started my career at Deloitte in San Francisco as a CPA and went on to grow my own CPA firm. And along the way in 2010, my wife and I started buying rental houses, flips and wholesaling and all that. She ended up managing the real estate. I focused on the tax side of things. So I grew a CPA firm really fast, about 100% every year. We doubled in size and grew up 500 or 600 tax returns, 5 staffers plus a team in India. And we really focused on high net worth syndicators in Texas, primarily in the Dallas area. So a lot of the gurus, so to speak, from that area are former clients of mine. So we had a big exit between 2016 and 2017 out of our properties. We also got into hotels and apartments, active and passive investment. So it worked out good for us. And then we traveled the world for 3 years. Best souvenir possible, that was our firstborn son in 2019. I think commercial real estate is a great way to make a lot of money. For us, we started a group called Financial Journey. We help self-directed millionaires do it themselves, turn wealth into the business, and as part of that, we now manage a couple of family offices. But the tax part is still near and dear to my heart. It's a big part of what we do with higher net worth families. So my primary business is Financial Journey, and then I also work with Prickly Pears and Palmettos, a tax firm run by my friend Gabe Hogan. We help him gut. And so we'll come in and do some of the high level tax strategy on some of the most sophisticated clients.
Keith introduced me to Gabe, and amazing attorney, tax attorney. So that's what's really important to us, is looking at how can you plan it, but also how can you comply. I always joke about, the great, the between the line, make sure we plan it out right. Most of the people buying houses or flipping houses, you only see the tip of the iceberg on what you buy in, what you return, maybe your CPA or your accountant just doing some calculations and just do the basic, and then just now here you go, call a day. You're not going to spend your time into it. No. But when you play into the $1 million room, it's different strategies that you have to put in place. So I hear a lot of real estate in my end is like people call it a magic tax shield. But for the high earning professional and like doctors, high individual network, and what is the true that investing into commercial building and creating tax saving, is it really help the W-2 at all?
Anytime you invest in commercial property, our goal should be to make as much money as possible.
The bottom line, the NOI, yep.
So then people will talk about depreciation and a lot of the deductions, and sometimes when a project is so successful, that depreciation isn't enough to offset the income associated with property. In my mind, that's a good thing. That means you're in a super profitable property.
Yeah.
Now others will structure deals in such a way there's a lot of depreciation, and sometimes that's really helpful. So what can happen is there are passive activity losses are limited to the passive income that you have if you're a passive investor. So if you're a doctor and you own your own practice and you own your own building, it's possible, assuming you meet certain criteria, that you could do a grouping election with those passive losses with your active ones and possibly use those losses that can be really helpful.
Let me understand that, because you own the building and then you also own the operation, so you combine those two and then you can create that full loss.
Correct. So especially if somebody can be a real estate professional, and usually there's one partner that is making all the money, maybe at a W-2, and then the spouse qualifies as a real estate professional, they're active in it. But for the vast majority of people, both spouses are working, you've got the executive, you've got the doctor, they're working together, they just have lots of W-2 income. That's where passive losses don't typically offset their income. They're usually stored away until years later when maybe there's the sale of the property or something. So they're not lost, they're just not usable in that moment.
So if you're high net worth W-2 individual, you have to have playing a role as an active in the real estate, then you can take that and deduct it and then offset your W-2.
Correct.
Yeah, amazing.
There's a few structures that I'm sure that we'll get into that could also be advantageous for them, but sometimes they require a little more sophistication.
Absolutely, that's why we have you. Can you alleviate a little bit in the real estate professional, which is the reps?
If you're involved in rental property that you actively control, that's a place where you can generate losses if it arises to a level of like 750 hours more a year where you're qualifying as a real estate professional and more hours than your day job. And so usually one spouse is the high income earner and the other one, especially if it's like a stay-at-home mom or something, an easier threshold.
That person has to work within the real estate, like 750 hours per year. Got it.
More hours than they spend in their day job. So most people spend 2,000 hours a year in a W-2. So if you have a full-time W-2, it's going to be really tough to hit that threshold in your real estate activity if you're not, because your 2,000 hours is way more than 750.
So the IRS can see that.
The IRS can see that you have a W-2. If you're making $200,000 or more, they're going to assume it's going to be full-time.
Right.
And then if you're also doing real estate professional at the same time, that's usually a flag.
Honestly, if you put the time into it and you have your wife or your husband stay at home, I think this is a bit good to, taking advantage of it for sure. 750 hours is not that much for a year, in my opinion, and that's big benefits.
It's rather significant, where I've seen some have found that they can actually quit their job, focus on real estate, and sometimes the tax savings alone more than justifies them not being in that role anymore. And often they find the real estate starts to grow more aggressively as part of that.
Yeah, absolutely. If they don't need that tax advantage, and then they definitely can work on the W-2.
When you're a high income earner, taxes are a big pain point.
Right.
And we don't want the tax tail wagging the dog. I'm investing, I'm focused first on preservation of capital, then the highest rate of return, and then thirdly, tax advantages. So if I put that one first, you're gonna find less scrupulous operators who are willing to put big things out there that say big tax deductions, and that's often what a lot of high income earners fall prey to. And they'll get the big tax deduction, and they'll get that big deduction, they'll say they're happy, and then they find out there's almost like no meaningful return of capital later.
A lot of our clients are doctors or high-income business owner as well. They also getting a massive income for their taxes. How would you help high network individual business owner to see how the real estate will play within their business?
So first and foremost, every family is different, and I'll talk about some general strategies with that. But when I get to sit down with somebody, usually within 5 or 10 minutes, we're able to come up with a list of things. There's literally thousands of strategies out there. It's about finding structures that make a difference. So one of the concepts we've talked about previously, like discounted rollovers, where somebody can invest in a retirement account. So let's say they invested $100,000 with you through their traditional IRA or 401k. We have a predictable drop in value. So let's say you are going to repurpose the use of that building. Day 2, you shut down that property, kick out the tenants as part of the business plan. In that example, maybe your $100,000 temporarily on paper gets reappraised at $50,000. We're able to stack other discounts, lack of marketability, lack of control on that. We do a rollover at $50,000, and then it pops up in value to maybe $200,000 a few years later because they invested with you, and now it's all within the Roth account.
Those are passive investing, right?
Strictly passive, absolutely. One of the other ones is stock market. Stock market's been reaching all-time new highs. As the returns go higher, so does the risk. And so I would be nervous about keeping all my eggs in one basket. Now is an opportunity to maybe consider like opportunity zone. You've got big gains there. If you were to sell, you could have next April, you could invest in an OZ fund. So funds, sometimes those, and then your new project is never taxed again.
Well, I'd love to have another sessions with you with the opportunity fund. Because I thought I'd start real estate going in and building and put a tenants in it. Now I realize there's more than just building and putting tenants, and I learn every single day. So there's more and more that you can make the project pencil out. Not on top of that, you'll be able to give an opportunity to build wealth.
So you're an expert in your craft of being able to buy, rehab, operate real estate. My side is now, what are the complementary tax strategies that go along the way? And not every strategy is right for every project, because a good tax strategy can not only help you personally, but can also really help your investors. I like to structure win-wins that are really good for everybody involved with the project.
How is that going to work with the cost segregations and the difference between the 39-year depreciations and accelerate the depreciation?
Cost segregation is a way to take your initial project, recognize a whole bunch of depreciation, frankly, in the year you need it. A lot of people use it right in the year of acquisition, but you can actually save it if you don't need the depreciation right away. I know for me, like when I sold my firm, I had a rather substantial number coming in. I waited a few years until the moment I had that cost seg come in. I then took it, wiped out all the ordinary income. I had a big revenue year that year, and now I just recognized capital gains. It was a six-figure tax swing for me each year.
See, that's why the tax strategies come into play.
Yes.
Ahead of the game. Don't wait until the years when the tax is about to file.
Proactively thinking through that can make the difference. And the other thing I like about cost seg is, let's say you bought a property in 2020 or whatever year in the past. You can now go back and take that big tax return back, and you can go back in time to the property to 2020, take a cost segregation now in 2026. I'm going to take all 5 years up through 2025 of depreciation all in this year, and so that can even be a bigger bump.
Let's go beyond the basics, right? And what's more advanced on the cost segs? When you use the partial of the asset for dispositions?
So often syndicators, when they like rip off the old roof, operators, and they put on a new roof, they just start depreciating the new roof. But in reality, you can take a write-off for taking off the old roof. If it's enough stuff that you're ripping out, you can do a partial disposition because you're partially disposing and pulling stuff out of the old property. And so that's a write-off that a lot of people miss. And then you've got the cost segregation. Let's take a simple example. Let's say we're doing apartments, or we've got an appliance like a $500 dishwasher. And because somebody invested with you, 5 years later that property is doubled in value. And most CPAs are going to say, okay, we're going to spread that doubling of assets across all the components. But when you dive down a little deeper, that $500 dishwasher didn't double in value to $1,000. What's a used dishwasher worth? $50, $100.
Exactly.
And so a second cost segregation study allows you to go in and say it's only worth $50. And now what I've done is I've limited my depreciation recapture to just that $50.
Yep.
And so instead of me taking depreciation recapture up to $500, we're talking multi-million-dollar properties. This is often hundreds of thousands of dollars in a tax swing.
That's why when I heard you, these recapture is intriguing me so much, because I did have no idea. I'm putting that appliances in there for, $500. That's what I thought. So you depreciate all that. Now you have to pay it in the end. Having an expert to analyze it and understand it at the beginning of this development. You make money when you buy. You don't make money when you sell real estate.
So one of the best things you can do is after you exit a property is to get into a new property.
Correct.
Because now we've got passive losses that are generated from the new property right away that can offset the sale from the old properties. Now that they've got the new losses offsetting the gains of the old one, it can often be a wash with little to no tax consequences. You may not even need to do a 1031.
Exactly. Most of the time, investors are used to the 1031s. But is it worth it to 1031 it? Sometimes you don't even need to.
Yeah.
Your money's stuck there for like how many months? 3-4 months there, and then you have to figure it out another property that you have to get in like mine.
So a 1031 can be a good strategy, but it's not the one size fits all strategy. There's a number of options out there. It's a 6-month lockup period, and sometimes if you really don't want to pay taxes that year and it's after July 1st, you're not doing a 1031 and you don't mind not touching your money for 6 months, having a failed 1031 will at least move the capital gain to the next year because you won't see your cash till January if you 1031 in July. So as long as you have the intent to do a 1031, you can still take advantage of it and still fail your 1031, and you just moved your tax liability into the new year.
That's another trick. I did not know that.
Right now we're at historic lows with 1031s.
Right.
Sometimes it makes sense just to pay the 15% taxes and move on. One of the things I will say it's almost never a good idea to do is a Delaware statutory trust, so at least the ones offered by your financial advisor. They typically earn 4 to 6%.
Yeah.
I'd be better off taking that money rather than earning 4 or 5% and just paying the taxes and deploying it much more efficiently. So there's so many fees involved, the middlemen eat up.
Yeah, exactly. What I don't understand is how much control do you have or what the fee's gonna eat up if you put it into somebody else's fund, for sure.
Yes.
For me right now is I rather focus on seeing another property and be able to roll it into right away. And that will bring the taxes down.
If I were doing anything, I would look at the opportunity zone fund, either setting up your own fund to invest in other people's projects or going into somebody else's fund. You just got a 10-year lockup period. That's kind of a long time.
Yeah.
But if you do your own fund, you can enter and exit other people's OZ projects.
Yeah.
And that's something that we've been doing on the family office side.
How does the 721 exchange allow an investor to move from active owner to passive, and how does that impact their deferred gains?
First and foremost, so the 721 is an UPREIT listing of real estate into publicly traded shares. You typically need about 30 million or more in property to really make it worthwhile. You can do less, but you want at least $1 million in equity before you even consider it. A typical path for that is somebody who's doing like a 1031 into a DST and then into the 721 UPREIT list. But then from DST to shares in a 721, that's the end goal. There's nowhere else to defer something out of that, but it does provide liquidity. So you can finally get out of that and avoid a tax bill that you build up over time.
So how would you recommend some of the clients working with that?
So I think it's another tool in the tool belt, and it's a possible exit strategy, especially if you've amassed a large commercial property portfolio over your lifetime. That might be the way to go. If I go back to the OZ, I'm gonna sound like a really big OZ fan. If you get creative, there's so many ways to do it. And this is where you wanna work with an advisor that understands, a tax strategist that really understands what you're doing, where you're going. I don't like being locked into a strategy unless there's only upside. That have flexibilities, especially for the next generation. Going the family office route though, real estate is one of the core things that almost every family gets into. It's either where they made their money or it's something they get into later that provides stable, consistent cash flow that really is a real stability in their portfolio.
That's amazing. Keith, we're going to talk separately on the family office. I also want to know where they can find you and how they can grow their portfolios.
Yeah, you can learn about me and the families I work with. My website is financialjourney.life. You can email me. I'm going to trust that you guys don't abuse this. Keith@financialjourney.life. And if you're looking for a great tax strategist, I'm happy to refer you to a team of people that I work with consistently and do a great job. That's Gabe, who Lezlie mentioned a moment ago.
Gabe, he's also have the background on auditors for IRS. Now he's
turned to the light side.
That's what I'm about to say. And then, being a part of a team for us to put these strategies together, it just makes a lot of sense. Keith, thank you so much for your time. We can chat more on the next episode.
Sounds great. Thank you for having me.